Morning, ladies and gentlemen. It's Tusanang PM Sebata once again. I'm just taking a liking to Activision Blizzard. This is a gaming platform. And yeah, I've done some research on this one, which I would like to record for my history and maybe eventually share it with some people. And I like this platform, FinViz, as a starting point. What I looked at is the PE is crazily high and the PEG ratio is there, and you work out the growth there, you get something in the region of 15%, which is not bad for a growth company to see a 15% growth. But what was a little bit worrying for me when I looked at these numbers was the return on investment. It was just about 7%, and lately the cost of capital for most of these companies is around 8. So I thought, well, could Activision Blizzard be actually destroying value? Because if its return on investment is less than its cost of capital, we have a problem. And yeah, the other thing I looked at is profitability. Gross margin is great, operating margin is fine, and the profit is not that bad, but it's a little bit low. And better and whatever, it's fine. It's within the range. It's nothing jumping out of me crazy there. And the analyst mean target price is about 80, which is just $1 basically, about 7% higher than where it's closed today after a 7% jump. So the analysts are not seeing much upside in this price, and these guys are very conservative. Basically what they're telling you that this is roughly the top. So I had an inclination and a bias towards this downside from the word go when I looked at these things. I don't like the PE. I don't like the target price being next to the price. So we are almost at the top, basically. The debt to equity is way too low. From my corporate financing, I would like to see this bumped up a little bit, but yeah, they run the company, I don't. And the key for me is that it's optionable. I like to take option positions, and this will be a little bit of a long view. That's why I'm not just using charts, I'm doing some basic fundamental analysis. Yeah, so after looking at this, I thought to myself, let me go and do my own valuation, intrinsic valuation. Then I pulled my spreadsheet, and after running my evaluation, I was a little bit surprised to see that the actual value per share which I was getting was 35 and the price was at 80. There is some serious gap here. This is like about more than 50% below the current price. And I thought, oh, well, this might be one which I would like to look at. Then after this, I also go and look at my charts. I'll just use the online one here. And my value is at about 35, which is about there, and it's close enough to that down the first meaningful support from where we are playing now, and it's way down. Since 2016, we have been racketing it up. But from a technical perspective, another point of note is this point there, which used to be resistance, became support there at 45. So these are the technical levels which I'm seeing basically in the long term. When I talk long term, I'm looking at a year plus. So when I do this, I'll be using LIPs, not just ordinary options. But looking at it from a technical perspective, you'll notice that the price has been going up. Let's take it from the June zone here. Price has been going up, but RSI has refused to confirm that. So has MACD also refused to confirm that. So technically we're having some form of divergence. So I expect somewhere in this region, even if we have had this bump, note that my Dickinson and Kitchenson are flat. And the cloud is really flattening out. I'm expecting a drop anytime, which will be highly significant. And my levels are the 35 and 45 levels to drop from there. So it's close enough to about 50% tanking on this. Then I also looked at its other competitor, which is EA in this gaming and multimedia space. EA is not that far off from its price. It's about 91, and the price is almost 120, 112. So it's close enough. So about a 20% difference there, which is not that huge. And if I look at the chart for EA, if I just go back there and pick on EA, you'll see EA has had a serious dump. So these charts are not strangers to some serious dumping. This sector, it moved from 150 there, now down to the 110 region, which is about close enough to more than 30, almost 30% down. So expecting a 50% down on Activision is not that bad. So that's just for comparison, and I also ran a proper valuation on EA, but I won't focus on it. I'll focus on this one, where I'd like to take some actions. And let me just go back and talk through my evaluation and what are the key things. These are just inputs. The revenue, I did not escalate it for the quarters. I just used the annual reports. So things might have changed, but not that significantly. And yeah, you go slowly with these. You can stop the video and watch them in more detail. But key for me was the growth there. I'm putting a compounding revenue growth of about 12 to about 13%. Yes, the current year was about 6%, but that previous year, if you look at it, the growth was 41%. So it was not a stable one. That's why I came up with this 13. And if you go to this chart here and you try to figure out the actual expected growth in earnings, you'll see it's in the region of 15%. So I'm a little bit below that. That is calculated from the PE and the growth there. So I am giving Activision a little bit more room on the growth. It's a little bit highly stated, but my 12% looks fine by me. Then pre-tax earnings before EBITDA, the current year is about 23. Industry numbers are those ones which are slightly below, and I cut that 23 down to about 21, which is just small, but my reasoning also came from here. My operating growth margin is about 21 here, so I was comfortable with the 21 region. That's where I got my 21 there. This is the reinvestment compounding one. If it's going to grow that fast, it needs to reinvest something. I put a 1%. Industry average is about 1% and 1.4. But when I calculated the current one, they were investing about 70.7%. So I gave them a 1% there, a 1 ratio there. Right, risk-free rate, it's given it's US. Initial cost of capital, I gave them a 2.8%. You can go through the calculation of how I factored that out. There we are, that's my netting of it, the debt part, the equity part. Equity, I was using market value. The debt is not really market value, it's just estimates of market value. I was using an unlevered beta average of about 0.96. Yeah, the rest of the stuff you can just slow it down and check my evaluation where I was coming with that. They have some operating leases. I did some calculations on them. I also recapitalized R&D, which they were expensing. And yeah, my story looks a little bit like this. So for revenues, I'm starting year 1 to year 5 at 12.5, and the last year 6 to 10 is dropping up to 6. So I'm saying eventually on year 10 and perpetually it will be growing at about 6%. This is a little bit high number because the current risk-free rate is about 3, and I'm saying they'll be growing at about double that. It's a stretch, but gaming, I'm seeing it's still growing, and I'm not seeing it as a company which is going to mature anytime soon. Operating margin, I kept it at 21%. Their current figure is about 23. And tax rate, US tax rate has been crazy. All along it was, their effective tax rate was 35, and now it's just dropped to 21. In fact, it's not even 35, their effective rate. They had a funny conglomerated type of effective tax rate. What I did is just took the marginal US tax rate and stuck it there, because they were moving funds from overseas into the US and once-off items, lots of crazy things. They were really trying to just confuse me, and I thought, well, for tax purposes, for current base year, 35. Year 1 to 5, it will move to 21% flat. So I used the marginal tax rate for them. I did not give them any benefit there. And yeah, the reinvestment, I used a 1. Marginal return on capital, we started with an 8.6%. It's going to go to 19 or so. That's where they're really operating if you remove all their funny games which they play in the income statement. Cost of capital started at 8.26%, likely to go down to 7.4%. Those are my estimates. And running those figures out, I came up with this cost of a value of per share of 35, which is almost half of where we are. That's my story, and yeah, it looks like this. I'm just flashing this one so that if somebody wants to really take a closer look, you can pause the video and have a look at how I came about it. I'll also try and attach a link of this full spreadsheet. It's taken from Dr. Aswat Damodaran. He created a template. I'm just using it to populate it and tweaking some of the things to own it. That's my evaluation. So as far as my evaluation is concerned, I'm seeing this one, intrinsic value being about half of where we are. And the 10 cows are telling me that this has had its run, and the support level is between the 35 and 45 range. That's where I expect it to go. And this I'm going to action. I'm going to put some leap options there. What basically the predominant structure which I'm going to have is the back ratio, where I'll take about 6 months selling the in the money put option and buying the out of the money put options to give me a net credit. But I'll go about 6 to 8 months on the one I'm selling and a full year on the one I'm buying. And I'll do the same for a put, for the call back spread, so that eventually I have a V set up. And as long as the price doesn't stay within the 80 zone, I'll crack it. Because with this back spread ratio, I don't want the price to stay flat within that 6 month period, which I'll be selling the options, and the ones which I'm buying are longer term, a year or more. So that will be my position. I'll be having my position somewhere there. Net, that position, as long as I close it before 6 months, whether the price stays flat, I'll still make little money, considering that it will be a credit. But if it moves down big, I'll kill it. If it moves up, I'll get some money, because I'm playing both sides of this market. But my predominant analysis is that this is going to drop from this 80 zone to somewhere in the 45, 35 zone. That's my analysis. That's my view. And that is my story. I thank you. That was Activision Blizzard. Thanks a lot. It's been Tusanang PM Sebata. Bye-bye, colleagues. Till next time.